Now we come to the fifth method of project evaluation technique, that is opportunity cost analysis. So this ideally does not involve much of an intense competition like we had in the present value, discounted cash flow, and stuff like that. This is just mainly a understanding, or you can say application of a common sense. What is the opportunity cost to accept a project or reject another project? Okay, so opportunity cost, ideally saying in layman terms, it is the cost of earning income which you forego for choosing the other option. It is the cost of benefits you have lost because you choose the other option, because you went with the other option. In this case of project evaluation techniques, or you can say, before going into the depth of project evaluation, let's understand how do you judge that in the layman's, or you can say in today's term. Let's say you have a weekend assignment, a part-time assignment which you can do on your weekend and earn a handsome amount of $1,000, but you choose to go out with relax with your friends. Okay, so here the opportunity cost for you to go out with your friends is $1,000 because you forgot one income and choose the other option. The cost of losing out on that income, that profit, is the opportunity cost for you at a personal level. When you expend some of your, when you and your friends share drinks and have a good time, and the amount you spend on those activities, that's another, that's incremental amount for you, but already you made a loss of an opportunity cost of $1,000. So that's simply as an opportunity cost. So let's look at an example from the project management perspective, and then I hope it will give a better understanding of how do you evaluate the opportunity cost. As I said, this is not going to be a really fancy kind of example where you have a whole lot of techniques, present value, discounting period, payback period, and stuff like that. This is going to be a simple layman question. So let's say we'll look at this example from a, not from project manager perspective ideally, but from a layman's investment term ideally. Okay, suppose you have $200,000 to invest, and you can choose among the following options. Okay, one is invested in government risk-free return scheme, which gives a return of say 5%. Okay, the other is your friend has approached you to invest in his startup, invest in your friend startup, which can give you a return of 12% after 3 years. And you do the same way, you invest in free for 3 years. Okay, for 3 years, and 12% per annum for 3 years. So now here you have to choose which investment option is the better for you, which is not one. The higher the risk, the higher the return. In the case of government risk return, the investment, or you can say the government risk return, does not carry any risk, hence they have the least return at say a normal rate of 5%. But your friend's startup is an attractive one, but also it possesses a high risk. You may or may not even recover the principal amount, or you may recover the principal partially in case the startup fails. Anything is possible. That's why it provides you with a higher return, that is of 12% a year. So now let us see what is the income which you're going to derive with this thing. So here you have your years, and $200,000 invested at 5% per annum for 3 years. That's going to give you an income of, let's say, for the timing, we'll just avoid the whole concept of present value because we're going to try to keep it as simple as possible. So year on year, your friend and your this bank is going to give you some return. We just look at their current values only. For the year one, 3 on $200,000, 5% gives you $10,000 of return. So for your government, you get, this is for government risk, government bonds. Okay, and now we're going to see your friend's startup option. This is going to give you a 12% return. So it's going to be $24,000 for 3 years. That's going to be $72,000. So here you might say that if you invest in your friend's startup, you're going to earn an income of $72,000. But that's not the case, guys. You're just going to earn an incremental profit of $42,000. Incremental income. And why so? Because to earn a $72,000 income, you had to forego an opportunity cost of a $30,000 income. That's how you only earn an incremental income of $42,000 in the long run after 3 years if you invest in your friend's startup. So this is the concept of opportunity cost, guys. When you forego one opportunity, you also need to evaluate the cost of income you forgot by rejecting that option. And when you determine the income you gain by the other investment, you need to understand only what was the incremental gain you made on that investment, because you already had to forego a secure, a risk-free opportunity to earn an income. Okay, although not really important from a calculation concept point of view, but really important to know as a project manager which project has how much incremental cost and which project has what opportunity lost, which project loses an opportunity cost to what extent. That will give you a more detailed analysis, a more clear idea of how to choose which projects and so on, guys. I hope this was easy to understand. With this, we complete our opportunity cost concept.